Right, we are live. Hey everybody, thanks for joining us. Just gonna get started here. I'm gonna kind of let it be live for a couple seconds before I actually jump in. I'm gonna introduce our speakers, our other speakers as well here in a second, but might as well say hi to Andrew Reichert and Josh Fisher, who are on here with us, helping us give some good info today.
Thanks, Andrew.
Yeah, thanks, Andrew. Nice to see you.
All right, we hit 1 o'clock. So welcome everybody. Thanks for joining. My name's Andrew LaPerry. I am the VP of Investor Relations for Burgo Capital. Today we're going to cover some investing basics. We're going to cover some market details and then how to make great investment decisions, go over some data points and basically all the things you want to look for. Feel free to add any questions to the Q&A panel. It should be on the left side of your screen. If you throw questions in there, I'll be able to see them. The team will be able to see them, and we'll make sure to get to them at the end of the session there. We'll have some time for Q&A. So, all right, let's get started. I'm going to first introduce our experts. I know I said their names already, but joining me is Andrew Reichert and Josh Fisher. Andrew Reichert is the founder and CEO of Burgo. He has over 15 years of experience in real estate and operations from an investing management standpoint, and also in a lot of other business endeavors. He's just got a lot of experience around the board. Josh heads up our acquisitions department at Burgo, and he's successfully sourced and closed on over $350 million of investment real estate. He's been with the team since the very beginning and is a huge part of our success here. Burgo Capital itself has been in business for a little over a decade. We manage just shy of 350 million in assets with over 3,600 units, and we've been able to do pretty well from the IRR standpoint, hovering around 19% across all of our exits. We have more than 100 employees, and we're still growing strong. So our webinar today, we're going to go through what the structure looks like, some key topics. First, we're going to dive into investment strategies from the 1%. We're going to compare some traditional investing strategies with what the really wealthy individuals are doing right now to really utilize their capital well. Second, we're going to dive into the market. We're going to look at current standings, what we're projecting, and kind of see where we're going to go from here. Third section is what is important. We're going to look at data. We're going to look at decision-making, how to use the data for decision-making and everything involved there. We're going to have a nice little Q&A session to answer all your questions, and then we're going to finish off. So without further ado, I am going to hand it over to Andrew Reichert to dive into our first section here. Andrew, take it away.
Awesome. Thanks so much, Andrew. And thank you all for joining. Excited to jump into just some broad content today related to investing in general. And some of this comes from my own experience having invested in my own portfolio. So excited to just share with you a little bit of what I've learned. So first of all, if you talk to most financial advisors and planners, and no disrespect to financial advisors and planners, I have a really good one who I trust and respect a lot, but oftentimes their go-to strategy is traditional equities and bonds. So basically, hey, you should just have an asset allocation that gives you exposure to the S&P 500 or mutual funds, along with some fixed income vehicles like bonds. Bonds aren't really a huge thing right now, given where interest rates are. But generally it's, hey, just invest in these traditional instruments. And, one of the things I noticed is that there's alignment of incentives for, various planners and advisors to put you into those kinds of vehicles. So I understand why so many people invest in those kinds of vehicles in the traditional world. But what I found is that that's actually not how the wealthy invest. If you look at folks with a net worth of 20 million and above, you find that there is a much broader asset allocation that includes things like real estate and private equity, maybe some hedge funds. So, you get much more creative strategies as you have folks investing from a little bit of a higher net worth standpoint, particularly as it relates to investable assets. So this is the actual asset allocation of folks in a particular group that has over 20 million of investable assets to be a part of that group. And just digging into that a little bit more detail, one of the things that I was really interested in is, okay, well, how does asset allocation or portfolio allocation change as you go up in total net worth? So I found this amazing chart. This is actually a friend of mine who runs a wealth management company, shared this graph of the particular net worth tiers. So you've got any net worth from $10,000 to $1 billion. And what is their asset allocation? What is the allocation of that net worth? Well, as you might expect, in the 10,000, net worth, there's a little bit of liquidity, probably a lot of their net worth tied up in their primary residence, vehicles, some retirement, government qualified programs like 401ks and IRAs, life insurance, and then that's really it. Maybe a little bit in other areas. But as you go down to $1 million, 10 million, 100 million, and $1 billion, you find these lower categories taking up a much larger percentage of their portfolio. Things like business interests and real estate. These other alternative investments, things like fixed income investments and hedge funds. And so I was just fascinated by that the wealthy invest different than the middle class or folks with lower net worths. And so then I started asking myself the question, well, as we look at investing, what are some of the things we need to be careful of that could actually destroy our wealth? What are some things that could potentially reduce or significantly reduce our net worth? Because once you've achieved that particular level of net worth, you want to obviously maintain that level. Well, one of the primary things that I look for when I'm evaluating my investments is what is the risk of principal investment loss? So what is the potential downside of my original investment going down? So for example, if you invest in the stock market and you buy a stock for $10 today and it's worth $9 tomorrow, that has just gone down 10%. Now, obviously in stocks, you hope that it goes up, but there is definite risk of principal investment loss. So that's one of the things that I look for as I look at and evaluating my investments. Similarly, taxes. So a lot of people look at just gross internal rate of return when they're evaluating various investment opportunities, but they don't think of, hey, what is that actually net the taxes that I'm going to pay on that return? And so I think it's really important to understand tax implications of our investments because, particularly as you get into that really high net worth and you're paying 37% ordinary income tax and a big chunk of your returns can really be eroded by taxes. And so there's great opportunity to, save on taxes, just understanding tax law and understanding those implications. And the third is like a black swan event. This is an unforeseen, catastrophic event that just could not be predicted. And a lot of times in hindsight, everybody will try to say, oh, I knew that was going to happen. But the reality of a black swan event is like, there's just not much you can do to predict that. So that can definitely be a destroyer of wealth. What you can do, although you can't predict it, you can hedge against it. Or you can, make sure that you're insuring against it, having some insurance in various areas. So always be thinking about, hey, what could potentially happen that could take my net worth down, and be hedging against those things. And these are some of the wealth destroyers that I found to be out there, and potential risks that I look for when mitigating when investing. So that's it from me. Just wanted to share a little bit of some of the research I've done as it relates to investing in general. And I will kick it back over to Andrew LaPerry to talk about the market.
Awesome. Hey, great stuff from Andrew about asset allocation. Now we're going to jump into the market and how it could impact your capital. So Andrew brought out a lot of different sections of where wealth could be allocated. And what we're actually going to focus on here is the largest chunk of the capital. So we're going to be focusing on the real estate portion and focusing on that market and how it can be affected. So interest rates are probably the most talked about topic among people who have any interest in investing pretty much anywhere. Over the last 4 years, it's been very aggressive, up, down, a lot of growth in interest rates in the last couple of years. And with rates at these high numbers, does real estate still make sense? Well, just like home buying, interest rate is not the only factor. It's also not the most pivotal factor when you're assessing where to invest. Now, whether rates are high or low, investments can still be found, and ones that really can help you hit some high profit numbers, even with high interest rates in the market. Now, all that being said, we do expect, for looking at the future, we do expect to see some adjustment over the next 12 to 18 months, trending towards some lower rates. So here you can see the SOFR curve. This basically is the baseline of where the government sets the bottom for, or the Fed sets the bottom for interest rates. And this affects the rest of what we get as consumers. So seeing that trending down through the remaining part of this year and also through 2025 and into the future, it's a good sign. Now, what is affecting that stabilization? Well, it's the stabilization of inflation. We're finally starting to see a little bit more stabilization from inflation. A lot of investors have been holding back capital due to some uneasiness in the market caused by inflation. Either they're just kind of letting it sit to the side because they're scared of how inflation is affecting investments. Because of the erratic growth that we saw from 2020 to 2023, a lot of people were just kind of scared or potentially just putting their money in something that let it grow with inflation. Now, as we level out, it does get easier for investors to reasonably predict performance in the market and predict performance of investments, and also have a better chance to make sure that their investments are going to hit the numbers that they think it will. Now, despite all of the challenges, we do still see some resilience in a couple areas of the real estate market. First off, there's a never-ending need for housing, and it continues to drive up rental prices, even as inflation was high and as inflation continues to cool. High interest rates coupled with drastic rise in housing prices have made people rely more on renting, and a sore and underappreciated area is that middle market where we see rent prices from maybe $1,000 to $1,700. A lot of new construction has been aiming at that high class, high end multifamily. So a lot of the existing multifamily, as maybe inflation starts to cool and incomes stop rising so aggressively due to that, we'll see more resurgence of that middle class there. This leaves Class B apartments harder to find and struggle to find them more reliably. Now, another section that's been doing really well is retail. So especially neighborhood and community shopping centers. So the big thing with these is that when we see strong performance in local, smaller shops, it's a really great indicator for community engagement of local residents. If the shops are performing well, you're more likely to see stable rent growth, stable occupancy, easier rent bumps. It's easier for us to raise the rent when people like where they live. And also because people feel comfortable that they're going to consistently have these amenities in an area. So it's kind of our view on the market right now. Those are the things that we're looking at down the road. But all this information really is useless without accurate data. If you're just looking at the high level, you can't really predict very well what's going to be going on in the future. So Josh is here to help us understand what to look for and how to find it from a slightly more granulated level. Josh?
Thanks, Andrew. Yeah, really appreciate that. So yeah, like Andrew mentioned, the importance of accurate data in making investment decisions with investment real estate really can't be overstated. Again, we're not buying a property because we think it looks pretty. We're buying a property to achieve investment outcomes, and we get our heads wrapped around the probability of achieving those outcomes by having good data sources and doing good data analysis. So first, how do we think about identifying a hotspot or a growth area in terms of an actual target geography? So there's a few things that we want to look at here. So we want to look at things like rising rents. If rents are going up, there's growth happening. We want to look at increased infrastructure investments. Again, an increase in infrastructure means increase in local amenities for residents and just generally more economic activity. Job growth is an important factor. Increasing median incomes, important factor that points to increased economic activity. And then there's population growth. And I would just note that investors are often myopically focused from our perspective on this single number to determine the markets into which they want to invest. If it's a growing population, we're in. If it's not, we're out. We think this is a mistake. So Pittsburgh, which is where we office and where we have a large or fairly large multifamily portfolio, is actually from a population growth standpoint is a steady population. We're not experiencing population growth. But within that steady population, we're experiencing a demographic shift from blue collar to white collar. So what does that mean? That means increasing median incomes, which result in rising rents. So this can be a hotspot without this sole population growth figure. So that's a sort of an axe to grind that I have. People I've found just look at the population growth number, and we're here to tell you, pay attention to it, but don't make it the only number that guides your market decisions. So what metrics and economic indicators do we want to pay attention to here? We will also want to look at GDP growth within the market, again, as a kind of primary measure of economic activity. We want to pay attention to those demographic shifts that I just mentioned. So looking at things like shifts over time in income and also migration patterns, which we'll talk about some software that can help with that later. And then we really want to get into some real estate specific metrics. So this would be things like occupancy rates in your given asset class. So if you're interested in retail, what is market occupancy in the market stock of retail plazas? Same with multifamily, really whatever asset class. You want to look at rental growth. Are rents trending upward or downward? You also want to pay attention to construction activity, both as an indicator of growth. If people are building new product, pretty good barometer of where the market's going, but you also want to do competitive analysis against construction activities. So if I'm looking at a property and I don't do my research, I might miss the fact that somebody's building a brand new product right down the road, which is going to compete with mine. So you want to have a really good finger on the pulse of construction activity. And then finally, cap rate trends. We'll talk more about this metric later, but this shows the ratio between the market's net operating income from an individual asset standpoint and purchase prices. So whether cap rates are going up or down or are remaining constant is something to pay attention to as you're looking to evaluate a particular market. Okay, so that's the data we want to look at. Where do we get it? Few different sources. So first, CoStar and Yardi Matrix are two real estate specific softwares for which you pay a subscription, but they're really pretty comprehensive. So both have huge amounts of data that they source and aggregate. They have different charts. They have different reports. They actually have economists that analyze all the data and do write-ups on individual markets. So they tend to be pricey, but for institutional investors, these are invaluable resources. We've been a CoStar subscriber for a long time, and it's really the gold standard in terms of market data. You can also look at the U.S. Census Bureau. This is free access to demographic information, like we just mentioned. Also, the Bureau of Labor Statistics for job growth and employment data. So these are both government agencies that keep track of these things, and that's available to investors to look at. You can also go a layer deeper and look at local government economic development offices. This can help you get some insight into infrastructure projects, what growth incentives is the local government offering, and that can help you kind of determine how likely growth is and if there are any incentives of which you can take advantage. And then finally, there's something called GIS technology, which stands for Geographic Information Systems. The 800-pound gorilla here is actually, it's a company called Esri, but this allows you to map and visualize areas with high growth potential. So you can select different filters that you care about from a data standpoint and layer that onto a map to help you identify what are the likely corridors of growth within a particular submarket, which can be very, very helpful. So what are some traditional techniques for data gathering and analysis? Market reports would be the first thing that comes to mind. So you want to look at reports that the big boys are putting out. So commercial real estate firms that have multiple business lines, they're operating in pretty much every geography in the world. So this would be groups like CBRE, Jones Lang LaSalle, Cushman & Wakefield. They're doing business in every geography in the world, and they put reports out saying how business is going, what trends they're seeing, and these are things that are generally freely accessible, and they've really done a lot of the analysis legwork for you. Again, we want to look at demographics. A really deep understanding of demographic shifts is important when you're looking within a market and when you're doing individual asset analysis. Again, you can look at the U.S. Census Bureau, the BLS, and again, CoStar is a great resource if you want to pony up a fairly significant annual fee to have access to all of this. They aggregate all of this, and again, they're local economists that have only a few markets assigned to them actually review all of this data, and they do write-ups on that analysis, which is very helpful. And then lastly, with traditional techniques, I sort of hate the word networking, but we're calling it networking. So this is just good old-fashioned building relationships with the folks who are doing business in the market in which you want to do business. There is just no replacement for boots on the ground relationships. They've got a finger on the pulse of activity based on transactions that aren't reflected in the data yet because they might not be fully transacted yet. I will say at Burgo, we invest a huge amount of time and capital into investing in key relationships in the markets in which we own and operate. That's how we determine what's going on, what are the trends that people are seeing, and it's also, frankly, how we source most of our investment opportunities is by investing in relationships with the folks who actually procure those activities. So what about some modern techniques? So here we've got predictive analytics and machine learning. So artificial intelligence is being talked about kind of all over the place. Real estate is no exception to that. So we're seeing platforms like Real Capital Analytics and Cherry use AI to try to project future market performance. We're also seeing some companies build their own custom machine learning algorithms to try to leverage their own data. You know, these are typically very large organizations that have treasure troves of internal data that they're leveraging technology to try to mine that data for actionable insights. Just noting, this tech is really still in its early stages. What we're talking about with predictive analytics and machine learning is really an innovative area of AI in real estate. So this is seeking alpha that others can't see, as opposed to productivity, which we're seeing loads of, and that's really more output in less time or in the same amount of time. So, the issue with real estate data is data tends to be very broad and not as deep. Every deal is different. And AI tends to shine where data is really narrow and really deep. So there are lots of trades in real estate, but they're all different. So AI, at least where it stands now, has limitations, although this is something that we're paying really close attention to. We at Burgo sort of like being on the cutting edge of things. So we're looking at AI applications across kind of our whole stack of services and investments, and we're seeing some exciting things develop. So risk-reward analysis. Now we've kind of thought about what data do we want to pay attention to, where do we go to get it. Now let's actually compare some investments and think about how to make investment decisions. So what are the key metrics that we want to pay attention to when comparing investments? So starting out with, the absolute 800-pound elephant type investments that you have to know about if you're going to invest in commercial real estate. First would be a cap rate. Again, and with disclaimer with all of these, I am assuming some level of knowledge about what these are. I'm more focused on how investors use them. But if you do have specific questions about the metrics themselves, please do pop those in the chat, and we're happy to talk about that during Q&A. So what's a cap rate? Cap rate is a property's net operating income divided by its asking price. So if a property nets $100,000 a year and it sells for $1 million, that is a 10% cap rate. So you can use a cap rate to compare an individual deal against national or local benchmarks to kind of determine the risk premiums associated with that particular deal. I will note this tends to be another metric that people can be completely focused on just one number, the cap rate. And the cap rate really only works on stabilized property with a stabilized stream of income. So in a broader market like today's market, where investors they're really looking at value add investments, this just becomes a less relevant metric because, if today's net operating income is $100,000, but you have a business plan for that property to increase it to $200,000, then the ratio between that 100 grand and the asking price just matters less because you're going to change the stream of income. So again, don't be myopically focused on cap rates. It is one metric. It is not the only metric. Next would be a cash on cash return. So this measures annual income relative to the total equity investment in the deal. And this accounts for leverage. So the amount of debt that you're going to use to buy a property is a highly personal decision. It's a highly variable decision. So this is less about the market and more about you and what your yearly percentage cash return will be relative to how much cash you put into the deal and how much annual debt you're servicing on the deal. And then lastly on this slide is the internal rate of return. So this is useful for long-term profitability projections, and it's much more relevant for a value add deal. So Burgo's in the market with a value add fund right now. It's called an opportunistic fund, where we're planning to buy a deal, and we have a plan for the asset, as I said, to pretty dramatically change the stream of income during our hold period. So the internal rate of return allows us to establish a benchmark. We've got to be over a certain internal rate of return for us to be interested in buying a deal, and then to compare different deals with one another using that metric, because that takes everything into account, from initial cash in to the cash out along the way, potentially even refinances during the hold period, and then our ultimate assumptions about terminal value when we go to sell. Some more metrics. A debt service coverage ratio is something that's important to pay attention to. This is really an important risk factor to consider as you're asking the question how much debt you want to put on an individual asset. This really assesses an asset's ability to cover its debt. A lender is going to impose a debt service coverage ratio on you as you are having debt conversations. A good rule of thumb is 1.25. So that means if your yearly mortgage on a property is $100,000, a 1.25 DSCR means that its net income is $125,000. So it's essentially how much cushion you have, how much net income could the property lose and you still be able to make your mortgage payment. But an individual investor might have a threshold here that's much higher than what the lender imposes on them. You might say, I really want to be at a 1.5 or above. So if I owe the bank $100K a year, I want to make sure that I'm netting $150,000 a year so that I have a significant cushion and some things could go wrong and I'm not losing sleep over concern about my ability to make the mortgage payment. And with that, I would just say it's really important for individuals to set their own return thresholds. An individual investor has to determine they have to look at all these different categories and kind of come up with their own thresholds for these different metrics. So for instance, a ground up developer who's buying a piece of dirt to, put 100 units on it is going to have a much different internal rate of return threshold to say, go, let's do it on a deal, than somebody who wants to buy an existing Class A multifamily asset in a high growth coastal market like a Miami or something like that. So the developer might say, if it's below a 25% IRR, I'm not interested. And they're assuming a lot more risk to generate that return. Whereas the Miami, Class A stabilized investor might say, if it's 8, 9, 10% IRR, I want to do. It's really up for you to determine what your own thresholds are based on your own investment goals, your risk appetite, things like that. So how do we actually leverage data to make investment decisions? A few examples here. So first would be rental pricing adjustments. So if you're buying a property, you want to look at the asset rental data. So that would be your rent roll for your multifamily property or your office property or industrial property. What are the actual rents that I'm getting? And you want to compare that to the market data, which you can get access to through some of the places that we just talked about. So CoStar or Yardi would have this data. And that allows you to determine, is there a disparity between rents at the property that I'm analyzing and what the market looks like? So, again, just an example here. If I'm looking at a multifamily deal and the average rent is $500 a month, and I've looked at the sub-market and the average rent for the same, 1-bedroom, 1-bath unit is $900 a month, pretty good indicator that I can do something with this, right? Maybe I can spend $8,000 a unit doing some luxury vinyl plank flooring and some new paint and maybe some new light fixtures to get to that new rent figure. And then once you actually own the asset, you want to be continually monitoring market rents relative to your portfolio to make sure, hey, have I missed the market? Has the market moved up? And I'm still down here. That's one of our favorite owners to buy from, is somebody who their market's moved up out from under them and they're just really not paying attention to it. But we as investors, of course, want to be monitoring that. Another example would be you want to pay attention to your debt. And there's software that allows you to monitor your credit exposure across your whole portfolio that can use some predictive analytics, machine learning, like we talked about, within your own portfolio to identify good candidates for things like refinances. So you can tell it what different ratios matter to you. And you might have 100 properties like we do, and you're not paying attention to this yourself for each deal, but excuse me, the software can actually say, hey, these 3 properties based on these metrics actually look like they're really good candidates for refinances, and you should take a look at that. Loan Boss is the software that we use. Shout out to Loan Boss, great product. And that's an example of software that helps you monitor your debt and leverage your own data to make good investment decisions and drive better investment outcomes. And then finally, demand forecasts. Again, predictive analytics with demand forecasts is something that people are talking about with great regularity right now. And this allows investors to ideally preempt supply shortages. So it's looking at market data and it's saying, hey, based on these different demographic shifts, growth trends, we think that there's a shortage of a given supply of a given asset class in this particular area, and that helps investors be able to take advantage of what the market should ultimately do. So a recap of some recommended tools with some new ones. Again, CoStar, comprehensive commercial real estate analytics and data, super powerful but fairly expensive. Argus Enterprise is portfolio management and asset analysis. This is a focus on office properties, but allows you to really quickly underwrite office deals and then to be able to manage them well once you do own them and have a portfolio. RedIQ, something similar for multifamily. So really cool technology. And again, this would be a productive use of AI as opposed to innovative kind of seeking alpha uses, where the goal here is more output. RedIQ estimates that they 4 to 5x the productivity of a given analyst, because rather than having to look at maybe a PDF of a rent roll and individually put every single rent for 150 units into your own Excel model, you can upload the PDF and RedIQ uses AI to do it for you. And again, focus on multifamily. Next, Yardi Matrix. Again, this is similar to CoStar with market data analytics, but Yardi actually also has a property management software, so they're able to leverage their own data set from the PM side to provide data to the Matrix customers. So that's a pretty interesting integration of technology and different data sets that they have. And then lastly, Real Capital Analytics focuses on transaction history and trends, again, for multifamily in particular. That is it for me. With that, I'll hand it over to Andrew LePerry for our Q&A session.
Man, I'll tell you, when we put Josh's section together, I didn't realize how long it was. Josh, great job.
Of course, thank you.
You did.
Lots to unpack.
Oh yeah. So much data to go through when you're looking at deals, and thanks for giving us the lowdown on all of that. That was awesome. We do want to open up for some questions. I'm not going to send the first one at Josh. So we have a couple here. I'm not going to send the first one at him. We'll give him a break for a second. I'm going to send the first one at Andrew Reichert here. Looks like, how do you recommend balancing a portfolio between real estate, private equity, public equities, things like that? Do you have kind of a way that you see as being the most useful?
Yeah, that's a great question, Andrew. So I think the short answer is it depends, which is, I know, not a great answer, but it really does depend on a number of factors. And first of all, I should mention, I'm not a financial advisor. You should obviously talk to your professional about this, talk to your advisor, your planner. Depends on a number of things. I mean, obviously it depends on where you are in that net worth tier. Depends on the total amount of investable assets that you have. Really depends on the age you are and when you plan to retire, what you plan to do with retirement. So it depends on a lot of factors. And there's just no silver bullet. And that's why there's a bunch of advisors out there that get paid to look at your unique situation and make a recommendation. I will say the conventional wisdom says diversification is good, which I do agree with. I mean, we obviously do some diversification as an organization, geographically, asset type. We like to diversify. And at the same time, I love this Andrew Carnegie quote. We're here in Pittsburgh. Andrew Carnegie said, "Put all your eggs in one basket and watch that basket." So, at some point, somebody probably would have said to Andrew Carnegie, like, "Hey, you're over allocated to steel. You have too much of your net worth in steel." Well, Andrew Carnegie's having the last laugh on that because he did really well. So I'm not saying that you should put 100% of your assets into any particular asset class, but the point is that there's just not a silver bullet for everybody. I'm obviously a proponent of real estate. I'm very biased when it comes to that. I have pretty much my entire net worth in real estate and in our own funds. But that's because I'm really bullish on that. And a lot of the things I talked about, the tax benefits, I really believe those to be unique and differentiated among investment profiles. But obviously, if you're not an accredited investor, you're not going to have private funds available to you. So you're going to have to do more things like public equities and more of the traditional asset allocation investment opportunities.
Nice. Yeah. Great answer. Rose said that the webinar has been interesting. So, hey, I appreciate that. Thank you so much. And do we have a deal to offer? We do. We're a capital firm. We always have investment opportunities. I would just suggest, my calendar is attached here. Feel free to grab some time in that, and we can dive deeper. Next question, either Josh or Andrew, what's the minimum number of years that you recommend holding on to an asset?
Yeah, I'm happy to take that one. I would say, again, kind of a cop out of an answer, but it's a highly specific question. It depends on your investment goals and I would say the business plan for the asset. So in general, deals that are focused on cash flow, investors tend to want to hold on to longer. So one of the great things about real estate is that it can provide, it's a vehicle that can provide predictable cash flow to just pay for your lifestyle, right? You kind of know after I collect all of my rent, pay all of my expenses, and pay the mortgage. What's my monthly cash flow going to be? So if you're buying a deal for cash flow, there are investors that hold deals fairly indefinitely, and either recycle their debt, keep putting new mortgages onto it, or we've done deals with owners who own deals completely outright with no debt on them. They're pure cash flow plays. For deals that are value add, where you're pretty dramatically changing the stream of income, those tend to be shorter life cycles because you're typically adding value within like a 12 to 36 month time horizon, and you tend to have the highest IRR when you sell pretty quickly after changing that stream of income. But again, you might have a great business plan and really like the property and want to hold on to it long term, and you have an understanding of what the cash flow will be, and that's what you're focused on, and you could hold it for a very long time. But to directly answer your question, what's the minimum number of years you recommend holding on to an asset? You tend to really not see anyone hold on to a deal for less than 3 years. I'm sure it happens. I would just say it's rare. And we see a lot of that. I mean, 5 years is a really popular, 5, 7, 10, I would say tend to be the most popular time horizons for a hold period in terms of number of years. Great question.
Nice. Yeah, great answer too. Thanks for that, Josh. I'm going to take this one. How do you set individual return thresholds based on risk reward appetites? Really, I think it depends on where you are at in your career, where you're at in your life. I find that generally people who are younger, who are earlier on in their careers, earlier on in their investment cycle, have a lot more risk appetite because it makes sense, right? When you have more time to make up for mistakes, it makes more sense and can be really beneficial to kind of strive for a little extra return, maybe take on a little more risk, go for a bigger IRR and things like that, versus when you're later in your career, when you're later in life and you're looking for maybe some more cash flow, maybe some income replacement, things like that. That's where the overall return thresholds of assets that are going to give higher cash flow and higher kind of stable returns are always going to be a little bit lower. So kind of balancing, depending on where you are in your life and in your career, with how the risk versus reward could potentially affect you at that time is in my mind the best way to go. I think that's where you want to try to balance those based on your needs. So that's what I've seen a lot of our investors doing as they're moving through. But I think we got one more here before we finish up the Q&A. And maybe Andrew Reichert, this one might be good for you. Can you share some common mistakes that maybe people have happened to them early on in investing in stuff like this, specifically real estate, and how maybe to avoid those?
Yeah, I could share lots of mistakes that I personally made over my career investing in real estate. Just in the interest of time, maybe I'll just bucket some of those mistakes and share some broad categories. Just a quick context for my answer. I started investing in real estate in 2007, bought my first property, managed it myself, did all the work myself, maintenance, leasing, everything myself. And then I grew to the place where I had 20 units that I was managing myself as well. And so a lot of the mistakes that I made, first category I'll mention are just in the operations. So, just not being a professional real estate operator, I had to just kind of figure it out on my own, and just made every operational mistake possible, from maintenance to leasing to delinquencies and evictions and, property management. There's just so much you don't know that you don't know when you first start managing real estate that you're inevitably going to make so many mistakes, as I did. So that's one category. The second category I would mention is underwriting. So like when acquiring an asset, there's just so much due diligence and underwriting, and it's just really, really important to dig into the asset. So over time, we developed, like 100-point checklist when acquiring an asset. So it's like it needs to check physical due diligence, financial due diligence. There's just so much that you have to dig into in acquiring an asset. You would never know all of those things before you acquire an asset for your first time. And so, I think the underwriting due diligence process is the second, kind of main category that I would point to. And then the third main category I would mention is just the concept of asset management, and in particular capitalization. I think it's really important. Oftentimes people buy an asset, again, myself included, and don't think about what is it going to take to actually operate this asset over the next 5 years, 10 years. Make sure I'm putting together a capital expense plan for that. Let me make sure that I'm allocating capital for that I'm well capitalized on the equity and on the debt. And so many people get themselves into trouble, particularly with developments. You start renovating a property to do a fix and flip, and next thing you know, you run out of money, or you build a new construction property and you're halfway done framing and you're like, where am I going to get the rest of the money for this? So the capitalization piece, I think, is big. So my three things I would say is operations, underwriting and due diligence, and financial asset management capitalization.
Awesome. Yeah, great points there. Well, everybody, I appreciate everybody joining us here. I'm going to send out, we did some fun Q&A stuff with you guys. I just sent out a survey. If you guys don't mind answering that helps us obviously make sure that these are beneficial and valuable and, actually enjoyable to watch. We're always trying to continue to do that. Aside from that, our next webinar in this session is going to be on September 4th. We're going to be talking about the profitability of impact investing. Make sure to join us for that one. If you want to register for that one, you'll get a link after this webinar. Thank you so much, everybody, for joining us today. We had a really good time sharing, some of our expertise, some of our insights, and we hope to see you again soon. Thanks so much to Josh and to Andrew for providing their time and their effort and putting all this together, and we hope to see you guys again soon.
Thanks, Andrew. Thanks, everyone.